So I wanted to take a few minutes to talk through the transactions for July so you guys could get a better understanding about what is going on. So a lot of these are in the PowerPoints under different scenarios, but some that we wanted to talk to. The first one, if you could pull up the list of transactions and then the corrected file of the right answers that I posted. If you have that in front of you, that might help make sense. The first one is the contribution. So basically what's happening here is sales are coming, you are selling part of your stock, part of your company out. And in exchange for that, you're giving common stock, the person's giving you cash. Since cash is an asset that is increasing, if you looked at your chart, when cash assets go up, you debit that account. So it's a debit to cash. And when common stock goes up, you credit that account. So if you look over there, you'll see that I did a debit for cash, credit to common stock. Looking down in the next column, you see that there was a debit to prepaid rent. If you look at the transaction, it says you prepaid 3 months of rent of $1,500. If you recall, I sent that other video explaining a little bit about what prepaid rent was. And that's essentially an asset because it's money that you're putting aside for something you're going to use in the future. So if you cancel, you can get some of that money back, so it's an asset. So in order to pay that, you're putting money into this prepaid rent account, and you have to use cash. So in this case, cash is going down, so you credit that. Remember I said that if you can determine if cash is in the transaction, you want to look to see if it's going up or down. If it's going up, you know you're always going to debit cash. If it's going down, you're going to credit cash. Another key word to look for if cash isn't involved, you'll know, is this phrase here, on account. This implies that it's either an accounts payable, meaning you owe somebody money, or an accounts receivable. In this case, you're purchasing equipment, so it's an accounts payable. And if you look over there, you'll see that it was a debit to the equipment, an asset increasing, a credit to accounts payable, a liability increasing. You really should go through each of the transactions and look back and forth. For the most part, they actually do make sense. Again, in the July 8th transaction, we're performing a service, they paid cash. Cash is going up. The service is service revenue. That is going up. Again, looking at cash first, cash is increasing. It's a debit to cash. Then you have to determine, well, if it's a debit to cash, what's my credit? You see that service revenue goes up with a credit, so that's obviously then the credit on the transaction. Skipping ahead, you'll see on July 18th, you did a service on account. Well, since you didn't receive cash, you know you did the service. You know service revenue is going to be a credit, but you didn't receive cash. It was on account. But this time it's not a payable. It's a receivable. And if you look down on July 18th, you'll see we did a debit to accounts receivable, a credit to service revenue. July 24th is a little confusing because it's a liability that's increasing. You're taking out a note, you're taking out a loan, and you're getting cash to go back with it. So you're getting cash going up, debit, but instead of a accounts payable, it's specifically a notes payable. So that's what we did there, is the credit, liability going up. For the next step, as I posted yesterday, you want to go ahead and use all these transactions and post them to the T accounts. Do that, watch the video. Hopefully we'll go from the next steps and we'll continue to go from there. Have a good one.